There's panic on Wall Street as the banks report the economy is worse than we thought. I'm your Steve Van Metre, and thanks for joining me today. And investors have been looking forward to second quarter earnings, hoping that they would be better than everyone thought and bring a tailwind to the equity market. But now that the banks are reporting, what we're finding out is the exact opposite, that things are much worse than we thought. Let's over to Morgan Stanley, where we picked today's story up, as rumors of my demise have been greatly exaggerated. And no, they're not talking about their bank. One of the more popular views over the past decade has been the eventual demise of the US dollar. After all, with the Fed printing so many dollars since the global financial crisis and then doubling down after the COVID pandemic hit 2 years ago, this idea has merit, except it doesn't, because the Fed didn't actually print money. Those that understand know they made bank reserves, and that's not money. No printing happened. Shame on you, Morgan Stanley. Indeed, the meteoric rise in cryptocurrencies was part of the problem. And given projected path for the rate hikes and quantitative tightening, M2 growth is likely to fall even further, and the dollar is unlikely to show any signs of demise until the Fed pivots, which seems unlikely anytime soon, especially after Friday's strong jobs report. And that's true. We're expected now to see at least a 75 basis point hike, and now the probabilities are rising. It'll be a full percentage point. Let's continue on, because this could not be coming at a worse time, as companies are already struggling with margin pressure from cost inflation, higher and unwanted inventories, and slower demand. And the main point for equity investors is this dollar strength is just another reason to think earnings revisions are coming down, despite people's claims as otherwise, over the next few earnings seasons, which starts next week, that being today. And therefore, the recent rally in stocks is likely to fizzle out before too long. And this is a case that we've made, and we said that as the Fed unwinds its balance sheet, it's going to bring profits down. That means earnings are coming down. Many said this couldn't happen, but yet the strong dollar is a huge player here. And what we can see from this chart from Morgan Stanley, and I apologize for it being blurry, but I was given a small copy and I blew it up. And that's what we've got. And we can see the dollar is indeed at extreme levels here. And what does this mean to earnings? Well, when you take the dollar in yellow and invert it against the S&P 500 earnings revision breadth, you can see as the dollar rallies, again showing inverted, what it means is that earnings breadth is headed lower. And that, of course, means that stock prices are likely falling. Now, what does this mean for the banks who are just reporting? Well, here's where the bad news comes, because many people thought the consumer was in better shape. Well, what we're finding out, no, they're not. And that has bad news for the banks. And where banks go, well, the rest of the market soon to follow. As Morgan Stanley shares slide after challenging quarter sparked top and bottom line miss, according to Zero Hedge, as second quarter earnings per share disappointed, printing $1.44 versus $1.56 expected. But the big headline maker was that revenue of $13.1 billion fell short of expectations of $13.3 billion, with the wealth management revenue of $5.74 billion missed the average estimate of $5.81 billion. But that's not the bigger issue here. Is looking ahead, Morgan Stanley took $101 million provision for credit losses, up from $73 million a year ago, suggesting the economy may not be as rosy as so many talking heads are continuing to proclaim. And what you're seeing here is a bank is setting aside money to deal with losses. And when banks are doing that, it's not a sign the economy is in good shape. If they think the economy is healthy and they think people can make their loan payments, they're going to shrink their loan loss reserves. But when they're increasing it, it's telling you up front that they believe that there's a potential for default, and they've got to set aside capital for that. Now let's head over to JP Morgan, who tumbles after revenue miss, buyback suspension, whoa, and dire outlook from the CEO, Jamie Dimon. And starting at the top, JP Morgan reported revenue of $31.63 billion, which came in below expectations of $31.97 billion, resulting in a 28% drop in profit, and earnings per share of $2.76, with also missed consensus of $2.88. As a result of the recent stress test and already scheduled GSIB increase, we will build capital and continue to effectively actively manage our RWA. In order to quickly meet higher requirements, we have temporarily suspended share buybacks, which will allow us to maximize flexibility to best serve our customers, clients, and community through a broad range of economic environments. And when they talk about building capital, what do the banks suggesting here? Look, the government, the stress tests are saying we need need to add more capital. We have some risk here, and that means they've got to buy more bonds. And to do that, they're suspending their very lucrative share buybacks, which we know executives love because they grant themselves shares and then sell them back to the bank through these share buyback programs. And of course, when the bank is doing this, it means things are actually a lot worse than we thought. But let's continue on, because Jamie Dimon goes on to say, in our global economy, we're dealing with two conflicting factors operating on different timetables. The U.S. economy continues to grow, and both the job market and consumer spending and their ability to spend remain healthy. But do they? We've been challenging that in this show, saying, look, wages are not keeping up with inflation. So the notion that the broad consumer, the average consumer out there is in great financial shape is not true. And that's what tells us, if this is where we're at with bank earnings now, if they're this bad now, where are they going to be next quarter and the quarter after, as all of this spending that we're supposed to happen doesn't actually happen? That's the risk here. But geopolitical tension, high inflation, waning consumer confidence, the uncertainty about how high rates have to go, and the never-before seen quantitative tightening, not true, we have seen it before, and their effects on global liquidity, combined with the war in Ukraine and its harmful effect on the global energy and food prices, are very likely to have negative consequences on the global economy sometime down the road. Well, they're having an effect now, and we are prepared for whatever happens, and we will continue to serve clients even in the toughest times. And so what the banks are saying here is, look, there's major problems out there, and that means it's going to continue to get worse. This is still just the beginning. And for many people, that means their investments, if these bank CEOs are right, are likely to head lower. And if you're concerned about that at all, well, you shouldn't be. There's one strategy that our chief strategist, Jeff Snyder, fully endorses, and that's Portfolio Shield. I'll put a link up here in the corner and the description below, because if he's right, and what these bank earnings are telling us is we are on the cusp of a deflationary recession, well, that's big news for bonds and big news for strategies like Portfolio Shield that hedge with them. But speaking of our chief strategist, Jeff, let's go over and look at his recent report to see that perhaps he's already predicted that what was happening with banks was already in the cards. From his daily brief, Money and Market Minute, the Eurodollar curve post CPI, he says, was unprecedented. Following this morning's release of another red-hot consumer price picture, U.S. Treasuries and bond prices more broadly initially sold off sharply before recovering, and then some, ending the day priced higher, rates lower, at least in the longer end. The front end of each curve has steepened as more rate hikes are priced into the near term, but only the near term. And what he's trying to say is, look, the market, even though the Fed, or even though the CPI was up, the bond market actually rallied, interest rates fell. It's indicating that the Fed has overplayed their hand. And we know the Fed's likely to continue to tighten, but the bond market is saying deflation is coming, and that's a risk, as Jeff mentions, only in the near term, because he goes on to say inversion deepened, particularly as bonds rallied following their initial post-CPI sell-off. And Eurodollar futures, the curve, beyond words at this point, I've never seen anything like it. An inversion beyond 100 basis points, making it more distorted than at any point during 2007. And that alone, he says, should grab your attention. So I want to be clear. What he's telling you here is, going into the great financial crisis, the Eurodollar futures curve predicted that the Fed was making a massive policy mistake and the deflation was coming. And indeed it did. What Jeff is saying is it's doing that again, but only in worse shape than it was going into the great financial crisis. Doesn't mean we'll have a great financial crisis. What it implies is something is coming that's going to cause the Fed to massively change their direction of the tightening and go from tightening to easing. And that means something bad indeed is coming. The high CPI will provide more short-run justification for rate hikes, reflecting the upward move up front. The back end beyond the December 22nd contract inverted even more, meaning the market is simultaneously pricing high probability of rate hikes, which we know is coming, along with an even higher probability that they won't matter, won't last, and will end up being even more rate cuts despite the June CPI numbers. And that's how you know that bond prices are likely to head higher, because the Eurodollar futures curve is actually telling you that. Now, if you'd like to get Jeff's research for a limited time, it's free down in the description, or you can go to the website, marketsinsiderpro.com, put in your email. Next report comes out 8:30 a.m. tomorrow morning. Now let's continue on, because the data today says the Fed is going to keep hiking. And as Jeff points out, that's bad news and only going to lead to something blowing up and a lot of rate cuts in a rapid fashion. U.S. producer prices top forecast, but signs of softening emerge as the producer price index climbs 11.3% from a year earlier and 1.1% from May. And 3/4 of the advance is due to goods, particularly the energy sector. And excluding the volatile food and energy components, the so-called core PPI climbed 0.4% from a month earlier. The 8.2% gain from a year ago was the smallest since November, so we're seeing a bit of a slowdown. Nonetheless, it will probably take months before inflation moderates at the household level. And I want you to key word here, take months. So when you think about what the Fed is doing, and they're going to make a decision in less than 2 weeks, they'll pause for a month, and then they will come back in September. It's like driving through your rearview mirror. This is a lagging indicator. It means it's going to take months for this to flow through, and that means the Fed is going to continue to tighten before, as Jeff points out, things get to be so bad, they're going to reverse course. A report Wednesday showed prices paid by consumers surged 9.1% in the year through June, the fastest pace in 4 decades, as wages are falling well behind. While retail gasoline and food costs may abate, prices for many services such as rents could stay elevated for even longer. And that ties us into the U.S. jobless claims rise to the highest since November in a holiday week, as applications for unemployment led by a big jump in New York, and layoffs are increasing from big companies like Google and Microsoft. And we talked about this as how the equity market goes down, that unemployment claims are going to rise. But that's not the issue here, because claims are still relatively low, but they're slowly moving higher. What's concerning is in the continuing claims. Let's take a look, because claims rose 9,000 to 244,000, which remain relatively low. The problem is we're seeing them slowly increase every week. The bigger issue as we have down here is when you look at continuing claims, they rose 72,500 last week, meaning there are people that are on the unemployment that are finding jobs, but now we're starting to see an increasingly larger number of people who aren't. That number is at 1.4 million now, suggesting that things are getting worse at a point where the Fed could weigh a historic 100 basis point hike after inflation scorcher, and futures now show a 1 in 2 chance of a supersized July move. And the 75 basis points are also now in play for the Fed's September meeting, and all that bodes for bad news for the economy. The banks are already starting to predict it. Our chief strategist, Jeff Snyder, has been saying this is coming, and looks like later this year we're going to find out whatever that really bad thing is going to cause the Fed to pivot. Well, maybe worse than investors can handle, and that is going to be worse than we thought. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.